Yo, what's good, everyone? Welcome back to Market Pulse USA. Stop scrolling for a second because what I'm about to break down tonight isn't just another financial headline. This is a move that most people won't even notice until it's way too late. And by then, your dollar's purchasing power could be absolutely wrecked. Last month in Beijing, something historic went down. A Chinese official stepped up to the podium, spoke for about 11 minutes, and basically lit a match under the global monetary system. Not with missiles, not with troops, with gold. And if you think that sounds dramatic, wait until you hear the exact strategy they just rolled out. Before we dive deep, if you value real financial analysis on YouTube, do me a solid. Hit that subscribe button right now and drop Market Pulse USA in the comments so I know you're here for the actual content. All right, let's jump in because this isn't just another news cycle. This is the opening move in a reserve currency war. China's central bank released an announcement that most mainstream media totally glossed over. It was short, clean, written like boring bureaucratic language. And that's exactly why it's so dangerous. Buried inside that routine language was one massive offer that changes everything about how global finance could work going forward. The offer? Foreign central banks and sovereign wealth funds can now store their gold inside Shanghai-based vaults. They can settle all the fees and transactions in Chinese yuan. And they get guarantees that are designed to look as strong as the traditional Western gold standard that's been around for decades. Sounds simple, right? Wrong. This isn't just a storage upgrade. This is a doorway for countries to move their gold reserves out of New York and London, reduce their exposure to the dollar system, and conduct official reserve activity inside China's financial infrastructure. And the moment enough countries walk through that doorway, the dollar's network effect starts to crack wide open. Now here's the key question everyone should be asking. Why would any country actually move their gold out of Western vaults? Simple answer, 2022 changed everything. In 2022, the West proved a critical point to every single central bank on the planet watching. Reserves stored in Western jurisdictions can be frozen, blocked, or weaponized for political purposes overnight. That event with Russia didn't just scare Moscow, it terrified every central banker worldwide, because central bankers don't react with emotion like politicians do. They react with cold, hard math and risk calculations. So China's pitch is brilliantly simple. Bring your gold here to our vaults, and we'll build you a safer lane to operate outside Western control. Let me make sense of what China actually built here, why it matters strategically, and what it could trigger next in global markets. Once we understand the mechanics clearly, I'll walk you through a month-by-month timeline of how this type of shift can snowball fast, how markets tend to react, and what it means for normal people holding assets priced in dollars. Because the real financial war isn't about tanks and bombs. It's about who controls settlement systems, who controls storage infrastructure, and who controls the rules when something goes wrong politically. Now, China's Shanghai vault system didn't just appear overnight out of thin air. By multiple reports and industry sources, this has been years in the making behind closed doors. Facilities, legal structures, insurance arrangements, audit procedures, secure transport relationships. The whole stack had to be built from scratch. And the first critical thing you need to understand is capacity. If you're building a vault just for domestic Chinese use, you size it for domestic needs only. But if you're building to attract foreign central banks globally, you size it like you're trying to compete directly with London and New York. That's exactly what this looks like when you dig into the details. The facility is described as multiple underground vaults designed specifically to handle allocated holdings. That means specific gold bars identified by unique serial numbers, held as segregated property. That word allocated isn't just marketing vibe, it's the entire game changer here. Because the Western gold ecosystem has two very different faces that most people don't understand. One face is real physical metal sitting in a named account that you own directly. The other face is paper claims, unallocated pools and layered contracts where actual ownership can get fuzzy and rehypothecation risk lives in the shadows where nobody talks about it. When China explicitly says allocated, segregated bar-by-bar storage, they're directly signaling to nervous central banks, we can give you the things some people worry they're not fully getting elsewhere. And you can see why that message lands powerfully right now, especially after what happened in 2022 with frozen Russian assets that shocked the world. But China didn't stop at just storage infrastructure. The promise explicitly includes comprehensive insurance coverage, not just vague, we'll take care of it language, but structured insurance frameworks designed to neutralize the biggest fear after 2022, the fear of political seizure of sovereign assets by foreign governments for geopolitical reasons. They're basically saying, even if relations get ugly between countries, we've built legal protections comparable to established Western standards. Is it perfect? No system is ever perfect. But the goal isn't perfection. The goal is making Shanghai feel like a legitimate alternative venue in the minds of cautious reserve managers who control trillions of dollars. Then comes independent auditing, which is absolutely critical for trust. If you're a sovereign entity moving billions of dollars worth of physical metal across borders, you don't just want a spreadsheet and a smile from officials. You want a third-party verification you can trust? China's pitch explicitly includes independent audits, physical bar counts, weight verification, and purity confirmation. All the boring technical stuff that becomes extremely exciting when trust is literally the only currency that matters in this game. And finally, repatriation rights. This is the part most people don't talk about, but central banks absolutely obsess over. Because storing gold in a foreign vault is only as valuable as your ability to get it back on demand when you need it. China's offer includes clearly defined delivery rights with specific timelines. And they know exactly why that matters. Because the world remembers past repatriation debates and the uncomfortable questions they created about who actually controls what gold. So when you add it all up, allocated structure, insurance framework, audit access, and repatriation guarantees, China is basically saying we can do the whole Western package, but inside our system instead. And then comes the real weapon in this strategy, the settlement currency. Because China isn't just offering physical storage for gold bars. China is offering an entire financial rail system, fees, contracts, gold swaps, credit lines, all settled in Chinese yuan with physical gold sitting right there in Shanghai vaults as collateral, as liquidity, as proof of seriousness. That's how you create an alternative reserve ecosystem without formally declaring a new gold standard that would freak everyone out. And that's why this is definitely not just a vault storage story. It's a reserve currency story. It's a payment infrastructure story. It's a network effect story that could reshape global finance over the next decade. Now let's talk about network effects because this is where people get seriously confused. The dollar is not dominant worldwide simply because the US economy is big. The dollar is dominant because the entire world uses it for everything. If you're a country trading commodities, settling invoices, rolling over debts, managing foreign reserves, you default to using dollars because everyone else defaults to dollars. That self-reinforcing loop is the actual moat protecting dollar dominance. But moats can drain slowly over time. If enough major players start doing more trade and holding more reserves in another currency unit, that reinforcing loop weakens. Not overnight, not in a single dramatic headline, but slowly at first, and then suddenly all at once when confidence breaks. That slowly then suddenly pattern is exactly what traps people who aren't paying attention. Now China has another massive advantage here, preparation over many years. They've been systematically accumulating gold for years while building bilateral trade links that reduce dollar usage, especially across the global commodity supply chain that runs the world economy. So when they announce a vault and settlement option now, it's not a standalone random move. It's the capstone on a long-term strategic plan. Make the yuan more usable internationally, more acceptable to trading partners, more backed by real infrastructure that works. Here's the part that makes markets twitch nervously. The moment even a handful of central banks begin exploratory discussions about potentially moving gold to Shanghai, everyone else watches carefully. Because reserve managers absolutely don't want to be last. They don't want to be the country still storing most of its precious metal reserves in a jurisdiction that could turn politically hostile overnight. They don't want to be holding a currency unit that's rapidly losing global market share if a major shift accelerates beyond their control. So they hedge their bets, they test the waters, they diversify just in case. And once that diversification trend begins happening at scale across multiple countries, it becomes a self-fulfilling trend. You've probably heard various numbers thrown around about China's actual gold holdings. Officially, China reports one specific number to international bodies. But analysts often argue the real total exposure is significantly larger when you include state-connected entities and strategic accumulation outside the headline official figure. I'm not going to pretend anyone knows the exact precise number. What matters strategically is the clear direction and the obvious intent behind the moves. China wants to be seen globally as gold serious. China wants gold culturally embedded domestically. China wants gold to be a reserve-adjacent asset internationally. And this vault offer is designed to turn that strategic desire into an actual service central banks can use. Now step back and ask yourself, why would a central bank care about yuan settlement specifically? Because settlement isn't just about how you pay bills. Settlement is about control over the entire financial system. If your trade flows, your currency swaps, your hedges, and your storage costs all run through dollar-denominated systems, you are fundamentally attached to the dollar network. You're attached to dollar liquidity conditions. You're attached to U.S. sanctions risk. You're attached to U.S. monetary policy decisions, whether you like it or not, regardless of what's best for your own country's economy. But if you can settle a meaningful chunk of that financial activity in Chinese yuan with gold sitting in Shanghai as neutral collateral, you're building optionality and leverage. Optionality is power. Now notice something clever about the messaging. China didn't come out and boldly say, we will replace the US dollar as global reserve currency tomorrow. They didn't need to make that declaration. They just quietly offered an alternative lane with enough credibility that real institutions managing trillions might actually consider using it seriously. And that's literally the only thing required to start this massive shift. Here's where mainstream financial media tends to completely mess this analysis up. They'll frame this move as purely symbolic. They'll say it's limited impact. They'll confidently declare the dollar is too big to fail. And in a narrow technical sense right now, they're correct. Massive systems don't flip overnight in a week, like a light switch turning off. But that's also exactly why they're dangerously wrong about the bigger picture. Because reserve currency systems don't collapse catastrophically in a single week. They erode gradually. They leak market share. They lose confidence, until one day the psychological trust that held the whole thing together just snaps. And when that confidence finally snaps, the repricing is absolutely brutal for anyone caught unprepared. I'm going to map out a plausible cascade scenario, not because I can magically see the future with a crystal ball, but because this is how institutional behavior historically tends to work when risk perception fundamentally changes. And as we go through this timeline, I want you to keep one critical thought in your head. Dollar reserve status is not some law of physics that can't change. It's a social agreement backed by infrastructure, and China is systematically building alternative infrastructure piece by piece. Here's stage one: quiet, exploratory discussions behind closed doors. A few countries, often commodity-linked, often geopolitically diversified from U.S. alliances, open diplomatic dialogues, they ask detailed questions about logistics, legal protections, insurance coverage, what happens if political relations sour between nations. These early movers don't need to transfer everything at once. They just need to credibly signal they're willing to consider it seriously. That signal alone fundamentally changes incentive structures for everyone watching. Then stage two: pilot transfers to test the system. A smaller central bank moves a modest portion of reserves, enough to thoroughly test the process, learn the paperwork, see how global markets actually react. If that pilot transfer goes smoothly without major problems, the next country watching feels safer about trying it themselves. If the next country feels safer, the one after that moves forward. And that's when you hit stage three: headline transfers that make global news. A major player publicly does it. And the biggest potential headline transfer would involve a commodity heavyweight nation, because that directly ties gold storage to actual trade flows. Oil exporters are the obvious example everyone's watching. If a major energy exporting nation publicly aligns storage infrastructure, settlement systems, and trade experimentation, all with China simultaneously, global markets read that as a long-term structural pivot away from dollars. And once markets read and price in that pivot trend, you get serious volatility across all asset classes as capital repositions. Now, at this stage of the cascade, what actually happens to the dollar in practice? It doesn't vanish into thin air magically. It gets hit hard where it's most vulnerable: marginal demand from foreign buyers. Reserve currencies survive long-term on steady, consistent, ongoing foreign demand for their debt instruments and liquidity. If foreign institutions systematically reduce marginal buying of dollar-denominated assets even modestly, yields have to rise to attract buyers. If yields rise meaningfully, borrowing becomes substantially more expensive. If borrowing becomes more expensive for a government already running absolutely massive structural deficits, the fiscal pressure increases dramatically. And here's the brutal trap that policymakers face. The system can respond by tightening monetary policy hard, which breaks economic growth and employment, or by easing and printing more, which breaks confidence and fuels inflation. Either path leads to serious economic pain. Let's talk about the actual scale of foreign dollar exposure globally. Foreign central banks and global investors collectively hold a truly massive amount of dollar-denominated assets worldwide. U.S. treasuries, bank deposits, corporate bonds, equities, the whole enormous pile. Those holdings exist fundamentally because of reserve currency status. They exist because dollars are useful everywhere for everything. But if a credible competing lane grows and matures, those holdings inevitably begin to diversify away. And diversification at this scale creates selling pressure. That selling pressure doesn't have to be panic-driven to matter economically. Even slow, consistent, methodical reduction of dollar exposure changes pricing dynamics over time in powerful ways. Now imagine a realistic world where the dollar's share of total global reserves slides just a few percentage points per year. At first, literally, nobody cares or even notices. Then suddenly, everyone cares intensely because when you cross certain psychological thresholds, behavior changes dramatically. The critical psychological threshold is the moment the dollar is no longer clearly dominant beyond question. At that inflection point, reserve managers start acting totally differently. They stop thinking default to dollars automatically and start thinking manage a diversified portfolio strategically. And once you become just another portfolio allocation option, you become replaceable. Now, the personal real-world consequences of reserve currency erosion aren't abstract economic theory. If your entire financial life is denominated in a currency that's losing external demand globally, you personally face higher import costs, higher inflation pressure, and higher interest rates. Even if your nominal income stays exactly the same on paper, your real purchasing power steadily falls. That's why reserve status matters enormously to ordinary people, not just Wall Street traders. It subsidizes government borrowing. It stabilizes the currency. It makes imports cheaper. It makes the whole American lifestyle economically easier to maintain. So when reserve status erodes, the lifestyle erodes with it. Here's the uncomfortable part that makes people defensive. If policymakers desperately try to defend the currency by keeping interest rates high, debt servicing costs become an absolute monster eating the budget. If they try to defend economic growth by cutting rates and printing money instead, the currency weakens, and inflation can accelerate rapidly. Either choice forces brutal trade-offs with no good options, and the more debt a system is carrying, the uglier those trade-offs become. I'm going to walk through a possible month-by-month sequence of how this could realistically play out. Again, not prophecy or prediction, but a realistic chain reaction based on how institutions historically tend to move when fundamental incentives shift. And as I do this, ask yourself honestly, if you were running a central bank, would you wait until everyone else moved first? Or would you want at least a small position in the new alternative lane just in case? January. Announcement and early whispers begin. Most markets shrug it off initially. A few countries quietly make phone calls. Two critical things happen behind the scenes. Lawyers carefully read the legal terms and logistics teams start mapping out the actual routes and procedures. February. First modest pilot transfer happens. A mid-sized central bank moves a small portion of reserves. The move isn't huge in size, but it's symbolically massive because it proves the new lane actually works in practice. Gold market specialists notice first, then currency traders start paying attention. March. A bigger headline drops. A commodity-linked country publicly makes it known they're actively exploring storage and settlement options with China. Maybe they carefully frame the language as diversification or risk management. But everyone in the market understands the real message being sent. Dollar index dips, gold rips higher, bond yields start twitching nervously. April. Regional blocs begin coordinating moves together. Southeast Asia is an obvious candidate because regional coordination amplifies collective bargaining power and reduces individual political risk. If multiple countries move together simultaneously, it looks way less like a random one-off and way more like a structural shift. May. The BRICS narrative really ramps up in media. Even if BRICS coordination is messy and politically complicated in reality, the symbolism is powerful for markets. Markets don't price perfect coordination. They price direction and momentum. June. A big surprise move happens. This is potentially the month where an actual U.S. ally does a pilot transfer. Not because they're anti-American, but because they're pro-survival and pro-protection of their own national reserves. This would be the psychological move that breaks the mental barrier. Because if allies start diversifying into the alternative Chinese lane, that lane becomes normalized and acceptable. July. Policy response from the U.S. Officials don't just give speeches, they deploy actual liquidity tools and mechanisms. Officials talk publicly about confidence, stability, and dollar strength. But markets listen way less to words and way more to actual capital flows and concrete actions. If rates get cut, the dollar can weaken. If rates are held high, debt servicing stress grows. Either policy path creates volatility. August. Acceleration phase begins. Once investors feel that policy response is limited and insufficient, focus shifts hard to inflation expectations and real purchasing power. That's when people rush frantically for hedges and protection. Hard assets start moving. Commodities surge. Real estate in certain areas moves, and average people start feeling the effects through higher prices at the grocery store. Now I want to pause here and make this practical and useful. If you're watching this video and you're successful, maybe you've built wealth, positioned well, made smart moves that worked, share your success story in the comments below. Not to flex or brag, but to genuinely help other people think through their own situations. Because your real experience might be exactly the spark someone else desperately needs right now. You might be thinking, okay, what do I actually do with this information? First rule, don't panic and make emotional decisions. Second, don't completely ignore this either. Third, honestly understand your exposure. If your savings, investments, and future plans are 100% dependent on one currency unit, you're vulnerable to that unit's repricing. Diversification isn't fear or pessimism, it's smart policy. I'm not telling you to do anything reckless or stupid. I'm telling you to think strategically like the actual people who run central bank reserves. They never bet everything on one single path. They always hold options across multiple scenarios. Let's talk about specific assets for a second. In a world where reserve currency dynamics are fundamentally shifting, You typically see serious pressure on long-duration bonds because bondholders need confidence in the underlying currency. You often see increased volatility in equities because corporate earnings might rise nominally but fall in real inflation-adjusted terms if inflation badly outruns growth. You often see dramatically increased interest in commodities and hard assets as hedges against currency debasement. And you often see people chasing narratives and stories, which creates temporary bubbles in weird, unexpected places. So the goal isn't to perfectly predict every market move. The goal is to build financial resilience across scenarios. Now let's zoom back to the vault system specifics, because one of the genuinely clever things China is doing is offering the feel and appearance of Western legal protections while embedding the operational reality inside their own controlled ecosystem. Allocated storage is the attractive bait. Insurance is the comfort factor. Audits provide credibility. Repatriation is the escape hatch if needed. But Yuan settlement is the strategic capture mechanism. Because once you're settling a growing share of official reserve flows in Yuan, you also grow Yuan liquidity globally. And once Yuan liquidity grows meaningfully, the currency becomes more useful for more transactions. And once it becomes more useful, more trade can shift to it. And then the self-reinforcing circle tightens. That's how you build a legitimate reserve currency contender, not by loudly announcing it, but by quietly building the infrastructure that makes it work. Here's a subtle but important point. China does not need to fully back the yuan with gold at a fixed convertible price like the old gold standard. They absolutely don't want that rigid constraint on monetary policy. What they want instead is an implicit linkage in people's minds. If you hold our currency, you can easily access gold in our secure venue. That perception makes the currency feel sturdier than pure fiat paper without forcing actual legal convertibility. It's strategically clever, it's flexible, and it's exactly the kind of middle path that can attract cautious institutions who want some gold backing without full gold standard constraints. Now, you might ask, why would anyone actually trust China's government? Here's the thing. They don't have to trust China more than they currently trust the West. They just have to trust China enough to hold a diversified slice. And once that slice becomes normalized and accepted, the slice naturally becomes a trend. All right, that's the breakdown. Subscribe to Market Pulse USA, drop a comment with your thoughts, and I'll see you in the next one. Peace.